Hello, everyone. I'm Aaron Johnson, a financial advisor with the Dwayne Johnson Group and Bridger Financial Services. So the markets continued their momentum from 2023 as we started the first quarter, motivated by the belief that we would see 6 rate cuts this year. This was extraordinary because not only did markets presume the Federal Reserve was done raising rates, but they also decided just how many cuts the Fed would provide. The Fed tempered expectations early in the year, and after a mid-quarter attitude adjustment, the market surged forward to end at around record levels. So let's look at the first quarter and discuss how we might expect the rest of 2024 to unfold. So let's go back to the market's expectations at the start of the year. It was true that the Fed had paused raising rates in the last few meetings as it assessed the impact of a 5.25% Fed funds rate on the economy. The Fed raised rates for the last time back in July, but at no time did they say they were stopping or signaling imminent cuts. So it seemed pretty remarkable that markets decided that A, the Fed was done, although they dropped many hints they were, and B, that we would eventually see 6 rate cuts, putting the Fed funds rate below 4% by the end of the year. Unemployment was still going strong at the beginning of the quarter, so one of the Fed's measures to determine whether or not to cut rates was not trending favorably. The Fed will feel better about dropping rates if we see unemployment in the 4 to 4.5% range. We're not there yet, and we haven't been above 4% since November of 2021. The other metric of inflation or price stability has come down from its 40-year high of 9.1% in June of 2022, but it's basically been stuck between 3 and 3.7% since June of 2023. So the stated 2% goal hasn't been met yet. That was the backdrop going into the quarter. The Fed was done and going to rate cuts, and consumers were still spending. The market soared to new records with tech companies leading the way. Then Fed Chair Jerome Powell doused any conceptions about imminent rate cuts and said it would be far more likely that we could see 3 rate cuts rather than 6, starting possibly in June. Markets didn't like this news, and the magic mood was broken momentarily. But as they shook off the realization that 6 cuts were off the table, they chose to focus on the stronger than expected earnings and the notion that rates were far more likely to decline than to go up. They also liked that the economy was hanging in there and not headed into a recession. Each piece of economic data was examined for what kind of impact it would have on the Fed's next moves. Markets liked what they saw, and the data was encouraging enough to keep them moving forward throughout the quarter. Gross domestic product, or GDP, for the fourth quarter of last year came in at a strong 3.2%, and real GDP was at 3.1% for 2023. So interest rates haven't resulted in a significant economic slowdown or recession yet. The markets reason that if current rates can sustain the market at those levels, then stocks will continue to perform well, no matter how many or how few rate cuts we see this year. We ended the quarter in equities much as the same way we began, with markets breaking records nearly every week. After a pretty strong 2023, we estimated GDP for the year will end around 3%. The estimate for the first quarter of GDP is in line with that 3% that we ended 2023 at. The first quarter advanced estimate for GDP will be reported on the 25th, just 2 days after this recording. We think it will be slightly lower than the estimated 3%, so we'll see how close we are to that on Thursday. We've maintained that a 4% on the 10-year Treasury is not healthy for stocks, yet the last time it dipped below 4% was after the January Fed meeting, and Powell's comments that I mentioned earlier. Rate curves have remained inverted, but as a recession has yet to occur, and almost all market observers have been wrong. This has been the most predicted recession to have never occurred. Although rate inversion has flattened a bit, short-term interest rates are still higher, signaling longer-term uncertainty in economic prospects. Once the Fed begins to cut rates, bonds should rally. But the age-old question is, when will that begin, and what can you do to take advantage? I still believe bonds are going to pay off in 2024, so I would not encourage anyone to abandon them just yet, as fixed income has returned as kind of a meaningful part of people's allocation. Still, the first quarter was really good for stock investors, and as we enter the second and third quarters, I expect markets to get a little more jittery, similar to what we saw last summer. We have banked significant gains in the first quarter, and people will start fretting and will be hypersensitive to any economic news that may alter the narrative of what's expected from the Fed. And just to be clear, expectations are for cuts to start in June. Any economic data that may cause the Fed to delay or even change its tune or consider rate increases could set the markets tumbling. Specifically, if energy prices continue to tick up from the current $80 per barrel, that would be inflationary. The Fed would have to stay put for longer, and if it's bad enough, might even have to consider raising rates. On the other hand, if unemployment rises above 4% and hovers below 4.5%, the markets will continue to rally, since it most certainly would mean the economy is weakening. In that case, the Fed would need to lower rates to keep things going. Then there's the upcoming election and all that may entail for the economy, and we'll discuss that as we get closer to November. We still believe that 2024 will be a solid year for the stock market. A strong first quarter is usually a good sign for the rest of the year. In the last 40 years, the S&P 500 delivered 28 positive quarter results, which are a pretty good indicator of how the rest of the year could end up. I expect we could end up another 5 to 8% from where levels are right now, but there will likely be bumps along the way. But the economy is still seemingly solid, unless the wheels fall off completely and the Fed does manage to deliver on a rate cut or two. I believe we should be in good shape for the next few months. The summer may be rocky, and we might have a pullback, but markets will likely continue to rally as we head into the fall. Please understand that this is my expectation, that given all that we know right now, since the environment can always change quickly. So we'll be back in another 3 months, and we'll just see how close we got to things and how things really went down. Staying the course and just being disciplined could be a reward again in the second quarter. Stay diligent, review your goals with your advisor. Remember, don't succumb to emotion, because that's usually a surefire way to get off track from your goals. Enjoy the spring. Please reach out to us if you have any questions. Thank you for your business, for your time. We really do appreciate it. And take care, and we'll see you next quarter.